Public and private companies are two different types of businesses, and choosing between them depends on factors like ownership, funding, and investment opportunities. Understanding their differences can help investors, entrepreneurs, and business owners make better financial decisions. A public company is a business that has sold shares to the public through a stock exchange. This means anyone can buy ownership in the company by purchasing its stock. Public companies are required to follow strict regulations, including financial disclosures and reporting to shareholders. Examples of public companies include Apple, Tesla, and Amazon. Because they have access to large amounts of capital from investors, public companies can expand rapidly. However, they also face pressure from shareholders, quarterly earnings expectations, and government regulations. A private company, on the other hand, is owned by individuals, families, or a small group of investors. Unlike public companies, private companies do not sell shares on the stock market. They rely on private funding, bank loans, or venture capital to grow. Examples of private companies include SpaceX, Chick-fil-A, and Cargill. Since private companies don't have to answer to public shareholders, they have more control over their decisions and can focus on long-term goals rather than short-term profits. However, raising money can be harder for private companies because they don't have access to public investors. Now, let's compare them side by side. First, ownership and control. Public companies are owned by shareholders, meaning decisions are often influenced by investors and the stock market. Private companies are owned by a smaller group, allowing for more independent decision-making. If maintaining full control is important, a private company is the better choice. Next, let's talk about funding. Public companies can raise money by selling stock, making it easier to finance large projects or expand globally. Private companies have to rely on loans, private investors, or reinvested profits. If access to large amounts of capital is important, public companies have the advantage. What about regulations? Public companies must follow strict rules from government agencies like the SEC, including financial reporting and transparency. Private companies face fewer regulations, making them easier to manage. If avoiding regulatory burdens is a priority, private companies win. Now, let's consider growth potential. Public companies have more resources to expand quickly, but they also face pressure to meet short-term profit goals. Private companies grow at their own pace, but may struggle to raise funds. If rapid expansion is the goal, public companies are the better choice. Finally, let's talk about investment opportunities. Public companies allow anyone to invest, making them accessible to everyday investors. Private companies are usually owned by founders, families, or private equity firms, limiting investment opportunities. If you're looking to invest, public companies offer more opportunities. So which one is the better choice? If a company wants to raise large amounts of money and expand quickly, going public is the best option. But if maintaining control and avoiding shareholder pressure is more important, staying private is the smarter choice. The best option depends on business goals and financial needs.